There we go. Welcome, Lars. The floor is yours.
Yeah, thank you very much, first of all, for having me for the Sustainable Finance Research Seminar today. And the paper I'm going to present today is called Do Retail Investors Value Environmental Impact? A Lab in a Field Experiment with Crowdfunders. And the paper is joint work with Christoph Siebenroth from the University of Essex. I think he's also today in the audience. So if I fail, I think Christoph is happy to bail me out. Okay, so let me start with a little motivation of our paper. As we all know, climate change is increasingly seen as a major societal problem, and addressing climate change and also reducing greenhouse gas emissions will require a lot of changes in the economy. And now the question that arises from that is who will actually pay for these changes and for the replacement of these old technology that we have. Obviously, investments in green technology are risky because this is a new technology and it's not clear whether all of these investments will be successful in the end. And the question is, will this actually be profitable in the end? And from that, one might actually raise the question whether investors who are engaging in these projects have a preference for doing something good, or do they just want to earn a higher return, or what is the reason why they engage in such investments? So this is actually what all our paper is all about. So the main research question is, do retail investors invest because they believe green projects are more profitable, or do they invest because they have preferences to achieve something positive for the environment, or something positive for the people that might suffer from environmental mistakes? So what do we do in this paper? First,
sorry, just do you think there's potentially a third motivation, that people simply want to own companies that they can identify with?
Absolutely. I mean, that could
the duration of PEG monitoring probation, so 63.6% reduction in
so I didn't get the second question, just because I didn't really properly hear it.
That was, I don't know who was speaking. I think it was somewhere else, right? But I had just one question.
Sure.
Right, yeah.
So I mean, the question was like, would people, just want to own certain companies because they identify with it? Well, of course, then the question is like, what would be the reason why they identify with it, right? I mean, you could say that that they identify with it is part of their innate preference to do something positive for the environment, because they believe that the company is doing something good for the environment. And then the question is, I mean, they could also want to own a company for many reasons that have nothing to do with environmental reasons, right? I mean, if they identify with it, right? I mean, if you own an iPhone, you might be willing to buy Apple stocks because you identify with it, but that's not a question of making an environmental impact, right? Did this answer the question, or?
That's true. Yeah, I mean, I guess you can wrap it into that preference, and then when you have things like home bias that may be related, I suppose.
Absolutely, absolutely. I mean, that could be the case, that you have a home bias or whatever bias, but that would be, I mean, we generally know that people have a home bias, right? I mean, it must not be the same thing, or it must not be related to environmental preferences, but it could be that you want to support your local environmental dealer, right? Okay, so what do we do in this paper? So we first test the hypothesis whether investors value environmental or social impact, or actually both. And this obviously raises a question in how we elicited or how we elicit the preferences of these people. Because the problem is, if you would simply ask them, do you think that environmental impact is an important thing for your investments? They might simply say yes, because that's just socially desirable. You wouldn't stand up and say, I think you should really screw up the environment. And for that reason, we have a problem with self-reporting and social desirability bias. And we address this with a lab in the field experiment and with real investors that have actually made investments before. And we also use a BDM procedure like many others before us, but I will show you in a minute what that is in case you haven't heard about it yet. What we also do is in this paper, we try to disentangle the E and the S in the environmental, social, and governance preferences, so the ESG preferences of investors. I think we are probably one of the first doing that. Okay, so let's move a bit into the theoretical literature on environmental investing. And I think you guys from this seminar have probably heard about this 100 times before. But as you know, in theory, you would actually expect that investors investing in ESG portfolios should make inferior investments in terms of a risk and return perspective. Why is that? Because investors that have only a risk and return motive should also hold non-ESG assets, because this will actually help them to increase their diversification potential. And if they don't do it, then in terms of a minimum variance portfolio, they should actually be less diversified and should have a worse risk-return profile. In terms of empirical literature, and I think most of the theoretical literature would agree upon that. So in terms of empirical literature, what we know is that there's a lot of mixed evidence. So some of the evidence is actually supporting the theoretical arguments, and a couple of them are also showing that actually so-called sin stocks are outperforming. Others are showing the opposite, that ESG stocks are outperforming the market. And obviously, this is also a question whether that is the short term or the long term. If you have a short-term perspective and there's a lot of demand for ESG stocks, then this increasing demand might actually drive up stock prices and those returns. But in line with the theoretical arguments, that shouldn't be anything that holds in the long run. Then there's a lot of experimental literature in recent years. And just to mention a couple of them, so one paper by Doskland and Patterson actually shows that investors choose green assets more for financial reasons than environmental reasons. And then there is a paper by Habe and others. I think Stefan Zeisberger is also in the audience today, and he's also one of the co-authors of the paper. And what they are showing in a lab in the field experiment as well is that the willingness to pay for mutual funds changes with the CO2 reductions these mutual funds are achieving. But what they show is that investors are willing to pay for a minimum level of impact, and they are not willing to pay more if the impact is increasing, and they explain that with a warm glow effect. If I didn't explain it correctly, I think Stefan is more than happy to explain it better than I did. Okay, so here comes our experiment. The experiment is run as an online experiment among 399 investors from the so-called rocket platforms. And the rocket platforms are threefold. So one is the green rocket platforms, which is a platform which is catering mostly projects in the green environment domain. And the home rocket platform is a real estate crowdfunding platform, mostly catering projects which are related to funding a real estate project. And the Lion rocket platform is a platform which enables investors to invest in startup companies. So we pre-registered our study, and it also got ethical approval from the University of Essex. And in this case, we pre-registered that we wanted to get data on 400 investors. So we are pretty close with 399 investors. So that's pretty much what we wanted to have. Here, I give you a couple of examples how the platform looks like. So this is the green rocket platform at the moment. If you go on the website, you see these startups, which will appear in short, and then you get informations, for instance, on the interest that you can earn. Here it's 6.5 and 7%, how long the loan is running. Just to make it clear, it's mostly annuity payments, so meaning that if you buy a loan, then it should be repaid on a monthly basis and you get your money back. That's a bit different from equity crowdfunding, where you get a bullet payment only in the end. Then you see how many people already invested and what the funding goal is, so that the project is successful, and how many people or how much money these people have invested. You can also look at the details. If you look at the details of the first project, you see that here you can buy products which don't have any anything wrapped around them. And then you can watch a video and you get information about the actual project. So for the home rocket platform, it's different, and I'm showing you that because I wanted to show you that, you know, if you look at these projects, it's really real estate projects. It's not that they have also an environmental touch in some way that you could say, well, they are renovating it and they put a beestock or something on top of the building, and so that could also have an environmental touch. That's not the case. So they're much different, and also how the projects are presented. You can see here they look at the interest rate much more, and then you see this one is running for 3 years, and so they had a goal of 600,000, but they don't have any environmental information attached to it. So the thing that we are doing, and if you're into experimental research, you probably all know what a BDM procedure is, but for those of you who have never seen it before, so in our case, the BDM procedure gives the investors a choice, and the choice looks as following. On the one hand, they can either get a voucher of 25 euros, and these guys have all been real investors. So for them, it's a real return. So imagine they want to make an investment of 100 euros. We give them a voucher of 25 euro for their next investment. That means they only have to invest 75%. So in expectation, they already made a return of 33%, meaning that they actually get the voucher is as good as money, you could say. On the other hand, they have to choose either to take the voucher, or we gave them 3 options, and they had to make decisions for all 3 of these options. And we asked them, you know, when would you be willing to give up the voucher? How much money would we have to donate for an environmental agency, either Greenpeace or a carbon footprint? Because some people might not like Greenpeace for that reason. We also took the carbon footprint company in here, which enables us with a donation to reduce CO2 emissions. And then we have the International Red Cross, and the International Red Cross has more social impact. So in that case, they had to make decisions for all 3 of these agencies, and then the computer would actually decide in the end for which one an actual donation would be made. So if they chose any amount that is here on the left side for the donation, and the computer later on chose any value that was above it, then the donation would actually triumph, and the donation would be made, and otherwise they would get the voucher. So to make it more clear to you how that worked is we gave them the following information. So that is how it looked like. Would you rather have a 25 euro home rocket voucher? And here it's important that we gave them a home rocket voucher, because home rocket has no environmental impact, but only a return impact. And on the other hand, they had to choose, or would you rather have a 1 euro donation for CO2 reductions, and so on. And then we told them, in order to make a long story short, they should only indicate, so that's why we have an adopted version of the BDM mechanism. They only had to indicate from which line onwards, which donation amount they would prefer to the voucher. Okay, so that's what we asked them. And so then they made their decisions, and we collected data in the following way. So we sent out emails to 4,771 investors in April this year. And in the end, what we found was that 399 investors actually participated. And we only selected people to email who actually have been investors before. And then overall 399 people took part in the survey, which is a response rate of 8.4%. And we also checked whether there's a non-response bias on 3 variables, namely on age, gender, and the platform they have signed up before. So we checked whether there is a non-response bias, and we didn't find any differences for the people in these categories, age, gender, and where they signed up first, for the people who took part in the survey and who didn't take part in the survey. Okay, so here comes our most important measure. So that's the measure I just showed you, the decision people had to make, namely their willingness to accept environmental impact. And as I showed you before, the donation we made would go either to Greenpeace, to the International Red Cross, or to Carbon Footprint. And if it goes to Greenpeace or Carbon Footprint, we would actually consider this as the willingness to accept green. And now it's important to realize the lower the value is people are accepting, the higher is actually their preference for environmental impact, right? I mean, if they would accept €1 donation relative to a 25 euro voucher for an investment, or for 25 euro excess return, as to say, that would mean the lower their willingness to accept the donation, the more impact they attach to, or the more important they perceive the impact of something being done for the environment. Okay,
I'm sorry.
So yeah.
Can I ask a question here?
Sure, jump in, yeah.
Thank you. So how difficult would it be to cash out this 25 voucher? Because then if I think rationally, I would say, okay, I take the 25 and I just donate the money myself to Greenpeace or another, like the Red Cross.
Yeah, so I mean, it would be easy in terms of cashing it out if they use the voucher and buy the investment. Of course, I mean, what they could do is they could use the voucher and you know, sell it on a bulletin board and tell other people that they could use it, for instance. I'm doing crowdfunding research for almost 10 years now, I would say, and I've seen such bulletin boards where people are selling not vouchers, but they're selling the parts of their stocks they had bought in a company. And this is very illiquid. So people are not really doing that. So it could be that the one or another person is trying to cash out the voucher, but I think this is not their first thought. I might be wrong in that, but that's not what I would think.
Yeah. So you're not like worried that you're just measuring some irrational behavior or something?
No, I mean, I'm following most of these forums on crowdfunding, on different social media pages and so on. I would guess that I would have seen if people are putting our voucher up and saying like, I got a voucher, are you willing to pay me 24 euros for it or something like that? First of all, I would think I would have seen it. And second, I would think that the transaction costs for these 25 euros might be too high, that people are actually bargaining on that.
Yeah, I agree. Thanks.
Sure.
Can I follow up on that? So thank you, Anne. That's an interesting question. Do you think, so Julian here, sorry for interrupting again, but I think this is interesting and central. Is there a fairness component, you know, like akin to these dictator games, where I think you are paying, you, the experimenter, are paying for both the voucher and the donation. Yeah. So somehow I might be thinking, well, I don't want to, you know, I want them to pay more than the voucher is worth. Otherwise, like they actually just save money. Yeah. Something like that. Might that play a role?
Well, then they would actually strategically play against us, right? I mean, they would have other regarding preferences, in the sense that they would say, well, I don't want the experimenters to do that. My feeling is, and I'm again might be wrong here, but I think the BDM procedure and the adopted version we have is probably a bit easier, but the BDM procedure is in the first place not very intuitive for people who have never done it before. But I mean, if you're an economist, you know how it works. But I mean, for people who have never done it before, I think it's quite tough. And saying that, I would think that, you know, their first thought is not like, you know, I think they are first thinking about, you know, how do they trade this off? You know, like what would the voucher be worth? Okay, it's 25 euros. And on the other hand, what would be the environmental donation? How much is that worth? And then they trade it off. That they would think, you know, there are other people involved. Could be that they have this second thoughts, but or this additional thoughts, but I'm not sure that that's the first thing that comes to their mind. Again, I might be wrong here, but I think the procedure is already so complex that I'm not sure that they would do that.
Yeah, thanks. Maybe you'll get to it. I'd be curious if there's a jump around 25.
Yes, there is. That's actually a good point. Yeah, let's look at it. I show that on the next slide actually. Let me just briefly finish outlining to you how the measures work. So I hope the first one is clear. So the first one is the willingness to accept, and it's the minimum for the willingness to accept green. It's the minimum of carbon offset and Greenpeace, because we didn't want to make a judgment which is more important. And for the other one, for the social, so where we disentangle the E and the S in ESG, we use the willingness to accept to donate to the Red Cross. It's not the next slide, so it's the next but one slide. Okay. So what you see here is the descriptive statistics for a lot of variables we have in the paper. And as you can see, we are losing a bit of sample size from 399 to 352 for multiple reasons. First of all, we excluded these people who didn't really understand the BDM procedures. Other might not have responded to all of the questions we included in the regression, and for that reason, we lost a couple of observations. So the first variable of interest is here the investment share in green. So investment share in green is what people have actually invested in their actual portfolio in green. So in this case, it's 44%, meaning that 56% are invested in some other investments, either in real estate or in startup companies. And then we have our willingness to accept measures for carbon offset, Greenpeace, Red Cross, and the combined green measure. And you can see that the mean is very similar for most of them. Then we have a battery of survey questions, and I will get to them once we look at the regressions. And then you can see that we have the age profile of these guys, gender, and their income, and their investment experience during the last year, and their current position in terms of whether they were students or self-employed or in the private sector, public sector, had no job, and so on. Okay, here is probably what you wanted to look at and whether there is a jump. So what you see is, first of all, on the right-hand side, so this is the willingness to accept 50, and let me explain this first for carbon offset. So what you see is that around 21 to 29%, depending on where you look at, would never choose or would choose the voucher and would not donate actually. And on the other hand, on the left-hand side, you see that people are accepting a willingness to accept 1. So for them, it's actually they would always forego the voucher, and they would use the donation, or they would go for the donation in any case. And the rest, for them, the impact actually matters. And now your question is whether there's a jump here in the middle with 25, and I would say, eyeballing it, probably there is one. So yeah, I'm not sure whether your interpretation to that would be that people are, thinking that it would be only fair that, it should be more in terms of donation, because, the money comes from the experimenters, and otherwise they would save money. Could be. Yeah, could be.
I mean, maybe getting also back to my earlier point, if I don't cash out the voucher directly, but if I don't know, do the deal with myself, saying that, okay, I use this for my investment, but because I was granted this voucher for the investment, then just out of my own money, I commit to payment to Greenpeace or carbon footprint. Yeah. I don't know whether such a rationale could be at work. So I don't know, maybe it would be interesting to see if you would have this either or scenario, like either there's no donation, nothing paid, whatever, or yeah, you can give a donation of 1 or 2 euros.
Yeah, absolutely. I mean, the reason why we did it that way is also that I think the interesting thing is that the paper by Stefan, I think what he argues is that it's more dichotomous choice, right? I mean, either you do something good for the environment and then you get the warm glow effect, and that's the reason why you do it. And actually, I think what is interesting here and what we actually show is that, you know, at least for this sample, you can show that these people are, you know, they truly trade it off. So it makes a difference for them. You know, you might say that there are, you know, other reasons for that, but at least I would say for those in the middle who are about 60% of the investors, you can say that for them, they really trade it off. So it's not a choice between I will always take the voucher or I will always go for the donation. So the size of the impact apparently plays a role for them. Okay, maybe to add on that, so first of all, what I just showed you, you can further show that actually there is a difference between carbon offset and Greenpeace. So people apparently prefer carbon offset to Greenpeace, so they would value this more. And then the second thing we tested was also the E and the S in ESG. And in this way, what we did was we compared the willingness to accept green with the willingness to accept to the Red Cross. And what you see here is that environmental impact is valued significantly more than the social impact. Actually, as you will see later on, this is actually what we also show in our regression results. Okay. So that I just told you. Let's look at our first regression results. And what we do here is what we seek to explain is the actual behavior of these people on the platform. And what you can see is the dependent variable here is the investment share in green projects these people have made. And the explanatory variable is our elicitation measure or experimental measure here, willingness to accept green. And then we have another measure, which is green profitability, which is simply a survey measure. And this survey measure simply asks them whether they think that projects on this platform or green projects on this platform are more profitable, equally profitable, or less profitable than projects on other platforms. And what you can see here is in terms of size effects, you can see that if people switch from they believe that projects on this platform are more profitable or green projects are more profitable than other projects, then you can see that the investment share in their actual portfolio in green projects increases by 20.6%. And as for the willingness to accept green, which means that if you would forego €1, or let's say if you would forego €10 in terms of donations, then this would increase your actual investment share in green investments on the platform by around 1%. Okay, so the next thing we did was, obviously, if you look at this Green Rocket platform and the other platforms, the real estate platform, for example, you could say, well, these people are particular in the first place, right? I mean, they might have an environmental preference in the first place. And for that reason, what we are picking up is a very selective group. And what we did here was we only took investors who didn't start investing on the Green Rocket platform, but who decided actively to choose first the real estate crowdfunding platform, Lion Rocket, so that we could say they entered the platform not for green reasons. So they entered the platform for other reasons. And what you see here is that still these effects hold, although they are small in magnitude, but you can see that if they believe that green projects are more profitable, relative to equally profitable, for example, then they would invest 6.6% more in green projects on in their portfolio. And if you look at the willingness to accept green, which is again the amount in euros you would be willing to donate, then you would see that also this would have a significant impact still on the investments they make in green projects on the respective platform. Okay, so this is both in line, and in case you're worrying why this is the opposite sign, so the opposite sign is for the following reason, because the lower your willingness to accept a green donation, the higher is actually your preference for green, and for that reason, there should be a negative sign expected here for the willingness to accept green, and a positive sign for whether they believe that green projects are more profitable. That shows you, in a sense, that actually both holds. So people who have preferences for green investments or for sustainable environment, and who believe that green projects are more profitable, invest a higher share in their actual investments in this portfolio. Okay, so next thing we did was obviously our the BDM procedure was truncated on the right hand side because the highest amount we gave them on a menu was they could either choose between 1 and 50 euros for the donation, or they could say, you know, I want to have a donation above 50, so there would never be a donation in that case. Okay, so we could say, well, maybe this truncation has a big effect, but what we see is that first of all, our measure for green profitability, the survey question, still remains the same. And actually, if you look at the coefficients from our initial regression, this is pretty much similar. And then we split the coefficients for the willingness to accept green for those who chose something between 1 and 50, and those who wanted to have a donation above 50. And you can see those guys who would never donate to green also had actual investments of 43.5% less in green projects in their portfolio. Okay, so to sum up these results, why do investors invest into green projects? Two main reasons. First, the environmental impact plays a role for them. But second, it's not only that, they also believe that green projects are more profitable, although that's not in line with modern portfolio theory. And second, even among the more conventional investors who didn't come to the platform for environmental reasons, but started to invest in real estate projects, even for them, we could show both. They would also invest more in green projects if they believe it's more profitable and if they have a preference for green projects. Okay.
Sorry, just for clarification, the who did not first join for green projects. So is that in real life they haven't, like these three platforms, they really exist, right?
Yes.
And
yes.
in
yes.
real
yes.
life, they haven't chosen to join the green. But in the course of the experiment, they did choose to do so. That's
not necessarily. So I mean, it's all in real life, right? I mean, they all invested actually on these platforms. So we made sure that all the people who are in our experiment have actually made investments. And so for the subsample of the conventional investors, we said that they must have started investing on one of these three platforms, but not on the green platform. So they must have gone to the real estate platform first.
okay, I got it.
But it must not be that they actually went to the green platform later on. Could be. I mean, some of them also diversified across platforms, but some potentially never did.
Okay, thank you.
Okay. So the second thing we wanted to do is we wanted to check out whether there's a difference for environmental and the social component. And we wanted to separate whether investors put their money into green projects for the environmental reason per se, so willingness to accept green, or whether they want to achieve a positive social impact by helping the environment. And you could think about, for instance, if you help the environment and the sea level is not rising, right? I mean, then this could also have an impact on people who wouldn't have to leave their islands because they are just flooded or something like that. And so making an environmental investment could also have social implications. And by our measure of the Red Cross, what you see is that there is no impact at all. So meaning that if they had a higher willingness to accept a donation to the Red Cross, this wouldn't have an impact on their investments they actually made on the platform. So what I showed you is like, the coefficient for social impact is not significant, but you could also interpret it in a way that what it tells you is that actually investors behave as if green projects have an environmental impact similar to the activities of the carbon offsetting company in Greenpeace, but the investments they make do not have a social impact in the same way the Red Cross achieves, which would have been the other way they could donate their money. Okay, final thing in this regression. Sure.
May I ask a question on
Absolutely.
this? So I don't recall perfectly anymore your descriptive statistics, but are you a bit worried that maybe the correlation is really high between Red Cross willingness to pay and green investments? Because then I could just imagine that in the regression setting, it might be hard to find an effect and really distinguish between your willingness to pay.
Okay, so I have to recall my econometrics class from Joachim Winter, and I hope I don't screw it up, but as I recall, multicollinearity isn't a problem for the standard errors, and it's not a problem for the coefficient per se. So I would think that the coefficient should still be there and should be 0.000, right? But the standard errors, it's not clear where to address or to which of the two effects to address the effect in the end. And so, but what we see here is that I mean, the coefficient is 0, right? I mean, there's no impact at all, meaning that and it's not statistically significant. So meaning that, what we should probably expect if there's multicollinearity, and I guess there is multicollinearity, is that if the problem you're describing is truly a problem, then there should be a coefficient here, but we don't know which one turns significant in the end because of multicollinearity.
Yeah, exactly. And I mean, you might, just in general, but have completely consistent estimates, or I mean, imagine you have like for 80% of your sample, those measures are exactly the same, and then for 20% it's not. Then you give like extremely high weight to those few observations where the measures different. So I don't know. I'm just wondering. Maybe you want to check correlations again there.
Absolutely, yeah. I mean, we can look that up, and I guess they are correlated. We could also report a variance inflation factor or something like that. But we have to check it up and just to make sure that it's not a problem. Okay. So that I just told you. So let's come to the last point. So the last thing we did was we also included a lot of survey measures we have collected before, and we wanted to check whether these survey measures actually have an impact on people's investments in their actual portfolios. And what we find is that the only thing that turns significant, and I will show you the longer regression in a second, I just stayed on that one because it's easier to see than the small figures that will follow, is that the belief in that climate change has to be addressed. So we asked one question about that with a 7-point Likert scale from 0, totally disagree, to 6, agree. And that's the only thing that turns significant and also has and is robust among OLS or Tobit regressions. I will show in a second. And so that means if you go up one item or one category on this question, then you would actually have a 3.8% higher investment share in green investments. So here's the full regression. So it's a bit big, but you can see that we previously used measures for risk seeking and time patience and so on from Domen and Falk and others, which have been validated before. And then we have our measure for a dummy variable for female versus all the other genders. And then we have the age categories and so on. You see there's nothing significant except job as a housewife. But if we run the Tobit regression, that will not be significant. And so the only thing that's robust is the belief that climate change should be addressed. Okay, fourth result. As I just showed you, demographic variables such as age, gender, income, job type, risk, and time preferences did not explain whether investors invested in green projects in the actual projects they invested on the platform. And neither did more time patients or risk-averse investors lean towards more green investments. The only exception is that if people believe that climate change should be addressed, this will have an impact which is robust and significant on their actual investments in the portfolio. Okay, last but one result. So what we do here is we check whether our survey measures, namely the importance of green and whether people are indifferent in terms of or interest in green projects. I will tell you in a second what that means. Actually, you have predictive power on their actual investments and whether they have predictive power on our experimental measures. And so we do so in order to actually check whether our survey questions are experimentally valid and whether they're externally valid. And if we do so and we find results for that, that is actually good news, because then other guys don't have to run the same thing we did before and do the entire experiment, because they could simply use the survey questions, because they will then be as good as our experimental measures and the actual investments people have taken. So the first thing is importance of green. So importance of green is a 3-point Likert scale of the importance people attach to green investments. And the indifference in interest of green projects is a measure where we ask people, how much more interest would a stock have to pay you if it's not a green stock? So, you know, of course, if people have a preference for green stocks, then they might actually be willing to sacrifice returns. But on the other hand, you could also put it that way: if they are forced to invest in a non-green stock, then you would have to pay them a higher return in order that they accept it. Okay, so we asked them this, and so they had to give us the percentage point. And what you can see is that if they attach a higher importance to green, and if they would request a higher percentage point in terms of interest, then this would have a negative impact on the willingness to accept the green voucher. Or you could formulate it differently. I mean, that would tell you that they have a larger preference for green impact. Okay, so then we know that actually these survey measures are experimentally valid. We also checked whether they are externally valid. And in this sense, what we did was we used the 2 survey measures in our study to predict the investment share of these people. And you can see that the higher their importance to green and the higher the interest rate you would have to pay them for a non-green investment, the larger are their actual investments into green projects. So finally, what we did was we included these 2 survey questions and added our experimental measure in order to predict the investments into green projects. And what you can see is that above and beyond our experimental measures, these survey measures still have explanatory power in different ways. First of all, you can see they are statistically significant and they have a positive impact. But moreover, you can also see that including both of them, the experimental measure and the survey measures, also the R² increases. So last thing we did, we checked for the importance of social. And what you can see here is that this is also significant and has the predicted sign. Okay, so that's what I just told you. Importance of green and indifference of green as survey measures are experimentally valid and predict field behavior. And the survey measures add something on top of the experimental measures. So last result. So the last thing we wanted to check was by simply asking some survey questions, which of the following characteristics of a project are important when you make an investment decision. And we gave them this list, and then they could, again, on a 3-point Likert scale, say it's not important, fairly important, or very important. And what we find here is, again, with the survey questions, they are in line with our experimental results. First of all, a high interest rate is the most important thing for investors, followed, which might be surprising, by environmental impact. And then you can see on rank 5, we also have social impact, but for instance, likability of the founders didn't play a role at all. And if you think about the venture capital literature, that's completely different, because in venture capital, people are mostly concerned about the founder team and they don't care about other things like social impact or something. Final result. Final result, we asked them, why do you engage in crowdfunding in the first place? I think it's also very interesting, even though it's not directly related to ESG or to sustainable finance. But what we find is that if you ask people why they engage in crowdfunding, the most important thing for them is they can choose the investments themselves, unlike in mutual funds or so. And also that there are more projects with green impact and with social impact. And you can see other reasons that play a much lesser role, for instance, that they're less risky or something like that. Okay. That I just told you, most important aspects is the promised interest rate, followed by a positive environmental impact, and people can determine themselves where the money goes. Okay, so what are the main 5 takeaways from this study? So first of all, I think it's very interesting that you can see in our study that a majority of the investors actually trade off a higher return for sufficiently large environmental impact. I think that is different from a couple of other studies that have recently been published or came out as working papers. And I think that is interesting. Second, you can see, why do people invest into green projects? So first of all, they think they are more profitable, and they also do it to have an environmental impact. Third, people invest in green projects for the environmental impact, but they act as if these environmental investments don't have any social impact, which might not be true in reality. Fourth, we could show that we have a couple of survey measures in our study which are experimentally valid and also predict field behavior. So they might actually help to run other studies much cheaper than we did. And finally, we see that people engage into crowdfunding because they can themselves determine where their money goes. So thank you very much for your attention. And if you're still looking for a Christmas present, I have a couple of suggestions here.
Great, fantastic. Thank you very much, Lars. So yeah, please. Still a lot of time for questions. Lars was very efficient. Go ahead.
I start. Hi, Lars. Nice to see you. I have a comment on your regressions. So some of the regressions, so given the fact that you have 352 observations, some of the regressions seem to be a little bit underpowered when you have like 35 to 40 explanatory variables. So then you, in some aspects, you claim that there's no effect or so. So maybe something to look into again. And I'm wondering generally about the selection into these platforms. Can you say anything about the sort of like the overall demographics of these, or do you have any idea of what type of people are these, and then in particular to what extent your results might be driven by sort of like a self-selection into these platforms that many people might not have heard of before?
Yeah, absolutely. I mean, first issue in terms of power, I mean, for sure, right? I mean, it might be an issue for our variable social, right? I mean, willingness to accept social, because that's not significant, but it's an experimental measure. We are actually interested in. I mean, for the survey questions, there are more controls, right? I mean, whether age or income is significant or not, it's more control measure we had included. We don't want to identify it. But for the other measures, right, I mean, the measures we are actually interested in, the profitability of the green investment and the impact of green, they are in fact significant. So it's not a matter of power, right? I mean, they're already significant. So I think the main problem where that could be or could be problematic is actually for the willingness to accept social, because that's a experimental measure we are interested in. As for the selection, of course, right? I mean, these are all people who are active on crowdfunding platforms. But as you could see from, I can also put up the descriptives again. You could see that they are, let's take this out. So they have also been invested in many other asset classes during. So if you look here, you see that, you know, the investment in bonds, stocks, deposits, active funds, and so on tells you whether they did this during the last year. So you can see that they are all also passive investors in other funds and so on in crypto. I think they are not looking that particular in that sense. Also, if you look at public sector, private sector, self-employed, and so on, I think that's looks pretty in line with what you see in the economy. But what you can say, and this is also something that I know from previous studies, is if you look at the gender divide, you can see that there are much more males than females in the study. But that's something that usually happens on crowdfunding platforms.
Would be, so if I look at crypto, for example, 23%, or so it seems to be a particular kind of people that are, I don't know, probably tech savvy. Is there any information about age? Or okay, I see the age distribution. Yeah. Okay. Yeah. So crypto 23% would be something. Okay, they're at least open to very new platforms, and that's I think why they ended up also in this platform. To what extent this drives your results is of course another question.
Yeah,
Thanks.
but I mean, there are also, I mean, there's this study, I think by Hacketal, who looks at the portfolios of people from a big bank in Germany and what they have engaged in crypto investments and so on. And actually, I'm not so sure whether crypto investments are particular for tech-savvy people. I mean, you must have a certain basic knowledge, but I recently talked to a friend of mine who is a train driver in Switzerland. And we went to school together, and he asked me whether you should sell his crypto stocks. And I thought, like, what? I mean, I never expected him to engage in these activities. And I think it's probably our prejudice that we believe that's something for techs and academic people. And I'm not sure it really is.
Right.
Good. Other questions? This is your chance. If you're still thinking about them, Lars, I was wondering now that you've showed the 5 main results. What do you see as the sort of central claim?
Well, I mean, first of all, I think a central claim is that, you know, apparently the extent of environmental impact plays a role for people. And I think that is new, because I think in a couple of other studies, people see it more as a dichotomous choice of people. And so I think that is new. And then the question that obviously arises from that is, you know, what does that mean? I mean, what kind of impact do you want to have? And you can actually see in our study already that it makes a difference whether you do carbon offsetting or whether you do Greenpeace, which might be more general and more politically oriented, for instance. And so that really plays a role. And I think if you think about the proposals that the central banks should also invest in green projects and so on, it also gives this political touch. And the question is, you know, yeah, is this in line with what people preferences are? And so that's the one thing. I think the other thing that is interesting is that you can see that you can actually use our survey measures in order to achieve or to conduct further research much more easily and cheaper than we did it. I think that's also methodologically interesting. And yeah, and I think that, of course, you could say it's a matter of underpowerment of our study, but I think it's interesting to see that at least there's now a difference between social and environmental, and that people put the environment in front and the social component comes second. And I think in reality, that's not always the case. I mean, if you think about, like I told you before, a lot of environmental measures, they also have a social impact. And investors behave, at least in our sample, as if that would not be the case.
Right. Okay, yeah, on this last point, it would be interesting to repeat this in the US. From what I hear, kind of the sustainable investor in the US is all about social things like, you know, social justice. And these are German investors. Yeah, so
Austrian, German, Swiss.
Austrian, German, as far as the cliche goes, I mean, that's what we would expect of Germans, that they, you know, focus more on the environment, perhaps. Yeah.
I mean, what would be even cooler, and I'm just giving out a very neat research idea, I guess, is if you could do it around the world, right? I mean, with 100 nations, and then get a nice Nature paper out of this and see whether the environmental preferences differ around the world. But probably this is already published and I'm just ignorant.
Just one question. Hi, this is Adrian. Just to follow up on Julian's question, because we had this discussion this morning, actually. Do you have a breakdown? I didn't find in the paper of by, you know, like even between like Switzerland and Germany, there's even, or there might be a difference in preference for the environment. And I mean, and then as Julian said, between the DACH region and other countries, the differences might be even bigger, right?
Yeah, I'm maybe Christoph crunched the data, so I'm not sure, but I think we didn't get the data on from the platform where these people are from, and they didn't do it in this survey, or they didn't say it in the survey. So I would have to check again whether that's actually the case. But I think we didn't get it from the platform. I think we could potentially get it later on, so we could at least compare it for these three countries, Austria, Switzerland, and Germany. That would be interesting, of course. We have to check whether that's actually feasible in terms of GDPR compliance, because we would have to ask the people before to give us the data, but that would be interesting, definitely, yeah.
Cool, yeah.
All right, we're nearing the end. Any other questions? Okay. Well, Lars, that's I guess my turn to thank you very much for coming here today, at least you know, virtually. Thank you so much for presenting. Keep up the good work. We wish you obviously the best of luck.
Yeah, thank you very much for having me. It was great fun, even though it's virtually, but it was much quicker and environmental friendly, of course.
That's exactly right. Yeah, and we can both have a, you know, have a drink later. Yeah, oh, there you go. Okay, well, so that concludes the official part. I'm going to stop the video here.